The Canadian government will tax your income. They'll tax your investments. They'll tax your capital gains. And if you're not careful, they'll even tax money you've already paid tax on again. But there are completely legal, government-approved ways to keep significantly more of your money. And most Canadians are leaving thousands of dollars on the table every single year simply because nobody ever explained this to them. This is the whole reason this channel exists. Let's get into it. If you've watched the earlier videos in this series, you already know about the TFSA and the RRSP, but let's zoom out and understand why they're so powerful from a tax perspective. Canada taxes income in two ways that matter here: income tax on what you earn and capital gains tax on what your investments make. Without a sheltered account, every time your investments grow and you sell, you owe the government a cut. Every dividend your ETF pays out taxable. Every year of gains potentially taxable. The TFSA eliminates this completely. The money inside a TFSA grows 100% tax-free. No tax on dividends, no tax on capital gains, no tax when you withdraw. The government already took their cut when you earned the money. They don't get another bite. The RRSP works differently. You get a tax deduction now, reducing your taxable income today, and you pay tax later when you withdraw in retirement, ideally at a lower rate. Done right, that's a significant lifetime tax saving. These two accounts are the foundation of every tax-efficient financial plan in Canada. Here's the priority order. Most financial planners will tell you, and it's good advice. Step 1. Employer RRSP matching. If your employer matches RRSP contributions, that's an instant 50 to 100% return on your money before it even gets invested. Always capture the full match first. Always. Step 2. Max your TFSA. The 2024 contribution limit is $7,000. If you've never contributed before and were 18 in 2009, you may have up to $95,000 in unused room. Check your MyCRA account to see your exact limit. Step 3. RRSP contributions. Once your TFSA is maxed, RRSP contributions make a lot of sense, especially if you're earning over $55,000, where your marginal tax rate starts climbing. We'll go deep on RRSP strategy next week. Step 4. Non-registered investing. Everything beyond that goes into a regular brokerage account. You'll pay taxes here, but there are still ways to minimize them, like holding Canadian dividend-paying stocks in this account, which get preferential dividend tax credits. Beyond accounts, there are a few other moves worth knowing. Income splitting in retirement. Once you're 65, you can split pension income with your spouse, moving money from the higher income earner to the lower one on paper, potentially saving thousands per year in taxes. The FHSA, or First Home Savings Account. If you're saving for your first home, the FHSA is one of the best accounts the government has ever created. You get the tax deduction of an RRSP and the tax-free growth and withdrawal of a TFSA, but only for a first home purchase. If you qualify, this should be near the top of your priority list. Capital gains timing. If you hold investments in a non-registered account and you're going to have a low income year, maybe you took time off or went back to school, that can be a smart time to realize capital gains at a lower tax rate. None of this requires an expensive accountant or a financial advisor. It just requires knowing the rules. Here's the honest truth. The Canadian tax system rewards people who understand it. It's not about loopholes or tricks. It's about using the accounts and rules the government literally designed to help you save. TFSA first. Employer match always. FHSA if you're buying a home. RRSP once you're in a high bracket. Next week, we're doing a full deep dive on the RRSP, the withdrawal strategy most people miss that could save them tens of thousands in retirement. Subscribe, and I'll see you there.